embracing all of the negative and not even the slightest possibility that this could work. What is this that I refer to? This is the new economic ideology. It's very clear what it is. I don't care whether you agree with it or not. The ideology is we're going to replace income and corporate taxes with tariffs, and we're going to do that in the context of a smaller government. I have no idea if that will work or not, nor does anyone else. That's the bad news. The good news is we're going to find out. We're going to find out pretty quickly. As far as the Trump put goes, and I'm in agreement with you on this, Steve, I would not want to see the Trump put in play because America wants to right now know what the rules of the road are and go forward with them. I was at a client dinner last night with 25 clients, many of whom were business owners, and most of them were talking about, okay, if these are the rules of the road, then let me adjust to it. Let me adjust production where it needs to be. Let me control costs where I can and move forward. That is American ingenuity. That is American drive. That is ingenuity and drive that far surpasses ingenuity and drive anywhere else in the world. It is what has always come to the rescue in moments like this. It may take time. It may take time. I'm not saying that today is the bottom, but I will say that down 15% in the S&P 500 is not a point at which I want to sell.
There are some things, Bryn, that investors are going to look at and say, you know, it's so bad, it's got to be good or close to it at this point. I point out your move today in Nike, down 15% this week, right in the crosshairs of tariffs related to China. And you bought it. You bought the stock. Why? Why now?
Really more Vietnam. I bought it yesterday, and really it's in relation to Vietnam. And so I think that whoever made that board that Trump had out should be fired with the math. Vietnam does not have a 90% tariff. It's absurd. They have a 5% tariff. And so what we have to decide as a country is what do we actually want to manufacture here, and what do we actually want to manufacture in great countries like Vietnam. Nike, Restoration Hardware, Wayfair all moved much of their manufacturing out of China during Trump's first presidency into Vietnam. Vietnam is happy to make these. Nike pays these people probably like $5,000 or $6,000 a year. They're happy to make them, and we do not want to export those jobs. My sense is there is going to be a reckoning between the U.S. and Vietnam. And actually, I think 20 minutes ago, Trump posted on his True Social that he just had a conversation with the General Secretary of Vietnam, and they want to bring down their tariffs, which once again are 5%, not 90. And so to me, it's like a beaten up name. I just think it's overdone. I think the stock could trade back up to $70 pretty quickly because we do not want to import these types of manufacturing to America. No Americans want those jobs. So to me, it was a trade. I think it's a fat pitch. I think Wayfair, Restoration Hardware, I think you're going to get some reprieve from these types of American companies doing the right thing.
You got anything, Jason, on your list in the spirit of what Bryn is doing and looking at in the market? What do you think?
Yeah, so I mean, there's a couple of things for me. As it relates to retail, obviously, you look at the RH blowout yesterday. I mean, the stock's down almost 40% in the last 2 days. You know, an American Wayfair, there's a number of names that I think have gotten really punched in the mouth. For me, I think about Apple, right? 90% of Apple's assembly and supply chains are in China. The stock was down almost 10% yesterday. It's down a lot today.
Below $200, I think, right?
200
earlier, yeah.
It's felt a lot of pain. We came into this year talking about the blunders in AI, and that was the concern. That was the weight on the stock. Then we start to look at the multiple, and then we look at the earnings growth. And obviously they've been moving their supply chains to India. They've been trying to figure out other things. But when I think about companies like that, they're the greatest companies in the world that sell premium products and have continued to monetize their services business. I think that this move is somewhat overblown. And those are the types of names that we like to take.
I mean, the Mag 7 collectively yesterday lost $1 trillion in market cap. To Jason's point, a lot of these stocks have gotten obliterated off of their 52-week highs. Out of the Mag 7, if you include Tesla, which is the worst by far, down 50% off its high, but Nvidia's 37, Meta is now 31% off of its high, Alphabet 28, Amazon 27, Apple is 25% off of its high. Its market cap is now once again below $3 trillion. You do not think that these tech stocks have corrected enough You told us before the show that you're short the Qs, which one could surmise you think that this trade has a lot lower to go, potentially.
Yeah, so I am short the Qs, and I'm short the Qs as a hedge against my long exposure in Meta, my long exposure into some of the other max. But I did sell NVIDIA, I did sell Vertiv, and I did sell Schneider Electric because, you know, economy's going down and they're for a robust economy. NVIDIA and Vertiv, which I just got back into, were small positions, and they were more trading positions. So I got stopped out of them at losses, of course, because stocks traded down through their stops, you know, overnight.
And I remember Gerstner telling us yesterday, right, of Altimeter, saying that, you know, I was a buyer. I'm a buyer of NVIDIA yesterday as this stock has gotten crushed in its own right, down 30% year to date. It's traded horribly, as all of you know. Broke below $100. It's at 94.19 as we speak. You just not moved by, you know, those declines enough to add to an NVIDIA rather than selling out of it?
No, because the narrative that I have is that we're going to recession. Trump will definitely be memorialized for the only world leader to put the entire world into a global recession, and that is my concern. I think that's a more likely reality than anything else. In terms of Apple, you know, we've got to, and this is with a lot of stocks, and again, you're also a great investor. I've known you for a while, know that you think, you know, about things very clearly and make decisions for the long term. Here's how I look at it. We're in such a unique period of time. And I said this the other day when people were saying, oh, this is going to be a buy the news event. But this is not a buy the news event. It wasn't, because it wasn't a single instance. Like the financial crisis, we knew a massive injection of liquidity could cure that. We knew that like Brexit, that was a one event and they would be just, you knew what the clarity was.
We didn't know in the depths of the financial crisis, however,
very true,
that a bazooka times 1,000's worth of liquidity was going to come into the market, which goes to the question I've asked people this week. In these types of times, over the last 2 days, how much the market is down. It's the worst time in your head to buy. You have to get beyond that if you're a longer-term investor and think that better things are coming down the road. The chances of you timing it perfectly are minuscule, but that's not what the game's about. You can't time it perfectly.
No.
Market's down a lot in the last couple of days.
And just to be clear, I was not predicting the bazooka. You know, what I was saying, there are market clearing events like the bazooka that were the all clear. We have nothing here because of the mass uncertainty that's going to be ongoing. So, yes, so you think about these times and reflexively, okay, wow, the market's down, you know, down big. I should buy because I know in a year or two, let me finish, Jim. But you could have made that case over the last month virtually any day, and look where you are. Any sale you've made to this day has been a great sale, and my view is that any sale you make now is still going to be a good sale because the market is overvalued on any historical measure without taking into account that, contrary to what you said at your meeting, is that there are no rules of the road that have yet been defined, because those rules, as a matter of fact, there's no road because it changes every day.
You made the position very clear. I'm going to take the other side somewhat surprisingly, right? Look, every time we have a big market downturn, all right, the reason is always different, and it's always unprecedented. You talk about COVID-19. Scott, you mentioned the great financial crisis, and honestly, the sentiment, the emails that were coming into me yesterday, the calls I was getting, were frankly reminiscent of the fall of 2008. It's always unprecedented. But Scott, what you were referring to about the timing is something that I have said time and time again. I've said it on the show. I've said it to clients repeatedly, that, and I'm going to give you some stats right now. The 50 best days, which, you know, if you miss the best days, you cut your returns dramatically, and they tend to come on the heels of absolutely terrible period of times. So the 50 best days since 1975, so over the last 50 years, are preceded by an average downturn in the month preceding of 6.7%, an average downturn in the 2 months preceding 10.2%. It's tautological. It is a historical truth. And those people who will say, well, this time is different, it's always different. I've been doing this. I've been investing for 45 years, okay? It is always unprecedented. It is always different. But what's not different are the figures that I just told you. And it's so hard to buy back in at times like these. That's why I don't try to sell out and time this.
Well, Bryn, you bought more of the JEPQ. Speaking of these big names in the market that have gotten crushed. And I know you wanted to take part in what we were just discussing. What's your point?
Yeah, well, so JEPQ is just the QQQs. So whereas Steve would go short, to hedge his technology exposure, I think JEPQ sells, well, I don't think, it does sell calls against the Qs. So the premium's going up. These are great companies. I get we don't know the E right now, and so that's where the P is coming under question. But I think that, to Jim's point, don't forget, we don't have an autocracy here, okay? Trump just can't do what he wants. The Republican Congress has been incredibly quiet. I promise you, they do not want to be one-term Congress people. And so as they go back home to their constituents, to small and medium-sized business owners who actually take advantage of the global supply chains, I think level heads will prevail. And so I think if we were under a Xi Jinping regime, yes, you could say this narrative is negative, we're going into a recession, but we are not. And I think Trump ultimately has these growth policies. We have a Congress, don't forget. I think they are very, very quickly going to change the narrative, or they will just get crushed in the midterms, which I get is not until November. And so I do think this is an opportunity, because whereas COVID March of 2020 and 9/11 Scott, those were exogenous events where there was no playbook here. This is a self-inflicted wound, 100%. And so at this point, I think that you have to think level heads will prevail. I totally get Steve's point. He did make a lot of good points, but I think that this is an opportunity to start nibbling here and stepping in, because we are not going to go into this global recession that he's going to torpedo in order to refinance rates 100, 200 basis points lower. I just don't buy into that.
Okay. I mean, it remains to be seen, and we're not going to know the answer to that question for many months. Speaking of things that are down a lot, you play off the tech names that I mentioned to you. The chips are down a bunch. Lam, Applied, KLA-Tencor, Broadcom, Micron, Taiwan Semi. What do we do with some of these names? You've got, chip exposure, obviously.
Yeah. I think for me, taking the longer view, right, and thinking about NVIDIA, obviously, which is our largest semiconductor exposure, and look at the 30% drawdown we've obviously had throughout this year. Export controls was obviously a concern coming into this year. That has been, at least for now, semiconductors and big pharma has been excluded from the tariff discussion. There will be something that will happen there. But when I get past the carnage and everything that's going on, and I see through the forest, I still like NVIDIA. I still like the fundamental tailwinds that are there. I still like the AI story. I still like them as the beltway and infrastructure for all that will happen in this space. And I perceive this as a longer-term opportunity, even if you need to average down for the next few quarters or few months.
Just to update you on where everything stands at the moment, we have a NASDAQ that is down by nearly 5%. Today, down more than 9% on the week. It's really been, the epicenter of a lot of the selling. I should also point out to you that the VIX is above 40. That's a 35% jump today, and the Dow Jones Industrial Average is down by about 1,600. I do have some breaking news. I want to get to Steve Kovac with that. Steve?
Hey, Scott, I'm here at Microsoft's headquarters in Redmond, Washington. This is their 50th anniversary party, and part of this whole event is some new features for Copilot. That's, of course, the app that they use, the chatbot AI app they use to compete against ChatGPT and DeepSeek and so many others. Two big features here to talk about. One is memory. This app can now remember a lot of personal details about you and use that in its answers to come back at you with. And another one is actions. This is actually kind of the hottest area in artificial intelligence right now, this idea that agents can act on your behalf. And we have Microsoft partnering with a bunch of different partners here that will work with Copilot now, so it can take actions on your behalf. 1-800-Flowers, Booking.com, OpenTable, companies like that. So the idea here is Copilot can go out there and order your mom flowers for Mother's Day, for example. I will note, though, that a lot of these features might sound old to people who have been tracking all these AI features. That's because it's largely reliant on OpenAI's technology. Some of these features were announced months ago by OpenAI to put in their own ChatGPT app. Microsoft, of course, has to wait for that to come out, put a little bit of their own AI flavor on top of it, and then make it happen. At the same time, Microsoft is still ahead of some of the others. That includes Apple, which, remember, they try to have that personal Siri assistant that does much of what Microsoft is launching today, Scott, and Microsoft is ahead there, of course. Amazon had Alexa Plus, which is supposed to have rolled out last month. It seems to be a little stumbling out of the gate there. But look, this is a big launch for Microsoft on its 50th anniversary, and we're going to keep the coverage going because over in Power Lunch, we have our own Andrew Ross Sorkin. He's going to be speaking with Microsoft CEO Satya Nadella. You're not going to want to miss that at 2:30 p.m. Eastern about this 50th anniversary. I'm sure they'll get into tariffs and so forth. And I'm going to be speaking with Microsoft CEO for artificial intelligence. That's Mustafa Suleyman on Closing Bell Overtime. That'll be around 4:10 p.m. Eastern about all these new Copilot features, competition with OpenAI, and so much more, Scott.
All right, Steve, good stuff. We'll look forward to all of that from you guys. That's Steve Kovac out there, as you see. With a lot of ownership of Microsoft, there's some thought that they were sort of first in, first out. Right, the stock has not traded well, but it's traded better more recently than some of the others.
It has.
How would you view this? I mean, whether the 50th anniversary or these advancements related to AI and Copilot move you in any way?
Yeah, so I think, as it relates to Copilot, obviously the story has been how have they been able to monetize Copilot, which obviously hasn't happened year to date. I think these new advancements as it relates to Copilot, I think is a positive. And then broadly speaking, when I think about Microsoft, I just think about their product, their suite of products are aimed for efficiency, and they're the perfect set of products for me in this type of cycle when folks and companies and small business enterprises are trying to figure out potentially how they need to cut costs. This is a company that they can turn to.
Okay. Thank you for that. We'll take a quick break. Josh Brown joins us on the other side. If you recall yesterday on the program, he looked at the market sell-off and the steep one that it was and had a lot of things on his mind about what you could buy, what he was thinking about. He's made some moves, more than one. He'll tell you them next.
CNBC. Live ambitiously. On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
The day's top stories driving Wall Street. Brian Sullivan joins Kelly Evans. Power Lunch, CNBC.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
It was a really good quarter.
This growth was driven by transactions.
Before they talked to Wall Street, they talked to John Ford and Morgan Bradley. Closing Bell Overtime.
back with more breaking news. Our Becky Quick joins us now on the phone. Bex, what do we know?
Hey, Scott, just wanted to let everyone know that Berkshire Hathaway is now responding to a post that was reposted, a video that was reposted on Truth Social by Donald Trump this morning. The president reposted a post that was originally posted on X yesterday by a user named American Papa Bear. He put out a video saying that Trump is playing chess while everyone else is playing checkers, saying that President Trump is intentionally crashing the stock market because he wants to see lower interest rates and many other things that he thinks will come from benefits that would come from that. As part of that video, it included some video of Warren Buffett with the proclamation that Warren Buffett was saying that Trump was making the best economic moves he's seen in the last 50 years. Berkshire Hathaway responding to that this morning, saying that reports that are currently circulating on social media, including Instagram, TikTok, Twitter, all such reports are false. It was a very brief statement from Berkshire, but I have just spoken with Warren Buffett. He says the reason that he is putting this out is he wants to make sure that in an age where misinformation can be blasted around instantaneously, that they are very alert and critical in making sure they're knocking down misinformation. He says that he's not talking to anybody about anything related to the markets, the economy, or tariffs, and that he will not be doing that between now and the annual meeting for Berkshire Hathaway, which takes place on Saturday, May 3rd. On Saturday, May 3rd, 8:30 a.m., they will hold that annual meeting that typically draws 40 or 45,000 people, maybe even more. Lots of people will be watching. We'll be broadcasting it not only on CNBC, but on CNBC.com. But he will be taking questions from shareholders at that point. But he wants to make it very clear that anything you see purportedly on social media coming from Warren Buffett about the markets, about the economy, about what's happening with tariffs, is not from him. He will not be making any commentary on that between now and the annual meeting on Saturday, May 3rd.
Let me just follow up with you, if I could, Becky, because nobody knows this man and his investing prowess over the last decade, at least, as you. It seems clear to me that they have maneuvered their way through these choppy markets better than most. They're up 11% is Berkshire year to date. A lot has been made of the fact that they've been sitting on a mountain of cash. And when the markets were at the highs, they couldn't find really anything that looked attractive enough to them because of the fact that so many things were at high levels. They had taken down some of their positions in Bank of America and Apple, for example. I'm just wondering from your own insight, what you take away from the fact that they have been able, and he has, which is why he is the oracle to begin with and the greatest investor who's ever lived, to maneuver their way through times of turbulence, and what you think it all says about what is happening at Berkshire Hathaway now.
Well, look, he has done this in the past, said that he's going to be very patient, look for the slow pitches. He doesn't mind doing nothing for years at a time if that's what it takes. And that's certainly what it seems like recently. He'll say that he won't be able to time the market, that's not his game. But he knows when stocks look expensive, and, he knows when things look like bargains. And my read on this, at least, of the $330 billion that they've amassed, that's sitting around $300+ billion, is that, yeah, they're waiting for the slow pitch, ready to be doing things. And when you start to see activity like we've seen, where stock markets start to drop, with the S&P down 12% or 12.25% as of yesterday's close, then add on the losses from today, sure, I would imagine that things start to look better at those prices. But, he's just not going to be somebody who overpays in his estimation for anything. He's not desperate to do things, and will be there when he thinks the prices are right.
We'll see what clarity we get out of the annual meeting, which is coming up, as you said. Thanks so much for coming on with that insight, Becky. Appreciate that.
Thanks, Scott.
All right. Josh Brown joins us now. By the way, I'll just get a comment from you, too. Josh, we're going to get to your moves in a moment, but you are a shareholder in Berkshire Hathaway, and you have such deep knowledge as well about how they operate and, what he must be thinking at the current time watching this kind of destruction that we've had over the last couple of days in this market.
I would just say that whatever people are betting he would do is probably not what's going to happen. He has a tendency of surprising the market of late. He's not doing obvious things like adding to existing holdings. The last major thing that we saw him do was acquire stakes in 5 Japanese trading firms, and that was so far off everyone's radar. I think he's up 50% on that basket, so it was a great move. It didn't make the playbook of even the most ardent Berkshire watchers. So don't play the game of thinking that you're going to think of what Warren Buffett might be thinking of, because you'll probably be disappointed.
Yeah, well, as I said, maybe we'll get some clarity on his direct thinking at the annual meeting. Let's get to you, because yesterday you went through the market and you saw a lot of things that were up in a down day. You tried to think of things that might be able to work in this kind of disruptive environment. You bought rocket companies, RKT. Let's start there. Tell me more.
Yeah, I bought in the pre-market as soon as I was watching Squawk and heard Steve Leisman come out with the new market-based projections of how many rate cuts we might get this year. The probability of 5 rate cuts is now, according to people in the bond market, on the table. And I don't know if that's going to be the reality. And, it's so early in the year still, and so much could happen. But just thinking about that, the next level is like, all right, well, who benefits the most if we were to see 5 Fed rate cuts, or even directionally if we got 3 or 4? And the answer is obvious. You're going to get a refi boom. You're going to get action in the existing home sales market. And you're going to see people take advantage of that, especially if they're struggling in the economy. That's exactly when you would get a refi boom. Happens every time. So Rocket is uniquely positioned, and they're very aggressively positioning themselves for what could be. They've announced 2 acquisitions in the last month. One of them the other day is Mr. Cooper, which is one of the largest mortgage servicing companies in the country, and the other is Redfin, which gets 5.5 million unique users on the website. It's a business of selling leads to realtors, but also that's a huge funnel for Rocket to sell mortgages to the consumer through. So this is the type of company that benefits if mortgage rates come down meaningfully, and we get a refi boom, and we break that logjam of all of these homes not on the market that need to be. So that seemed really obvious to me. I'm up in it right off the bat, and I'm planning to stick with it.
You've added as well to Amazon, Uber, and Chevron. Give us a little insight.
These are core positions. These aren't short-term trades. I think of all 3 of these companies as being companies that will be standing at the end of the trade war. I don't know that this is the bottom for any of them, but buying Amazon in a 30% drawdown seems like a smart decision if you're planning to be a long-term shareholder. Chevron, the lower it goes, the higher the dividend goes, and I don't believe we're going to see the level of demand destruction for gasoline that the current price in crude would reflect. I think it's an overreaction. We've seen the price of oil go to negative numbers, so we know you can get overreactions in commodities. So I thought that was a layup. The stock's been hammered over the last couple of days. And then Uber, look, I think the stock's worth $100 right now. So when they take it down from 75 to 65, I have to do something.
I got you. You spoke a lot yesterday as well about some exchanges. You singled out the CME group specifically, but that leads me to something you sold, which is NASDAQ, NDAQ.
Yeah, look, NASDAQ, I have a small gain, and I've been in it for a long time. The original thesis was that 2025 would be the year we would see the return of the IPO and a lot more capital formation, and that's a really important part of their business. About half their business is like listings. So they also have some fintech and other stuff they do, but like the only way that stock works is if the capital markets are unfrozen and we get deal volume back. Obviously, the events of the last couple of days, they have to change your mind about that. So I think NASDAQ's fine, fantastic company. I may revisit, but right now is the greatest hits moment. You want the greatest hits in the set list. You don't want your 9th or 10th or 11th best idea. You really want to be focused on things like long-term core holdings that have come down 15, 20%, where if you're going to be in it anyway, you might as well have more stock and lower your average price.
I want your take, too. I see that J.P. Morgan, maybe it's their trading desk, says that retail investors bought $4.7 billion worth of stocks on Thursday, the largest level over the past decade. So clearly there are others who see opportunity. And, I've had people tell me, well, one of the reasons why you haven't had a greater flush in the market, as bad as this has felt, is because retail hasn't thrown in the towel yet. And in fact, there are retail investors out there who saw the upset yesterday and maybe today as well and say, like you, there's just opportunity to be had still.
Yeah, I mean, I'm 48 years old. My time horizon is decades. So if I like a stock and I was comfortable owning it 15, 20% higher, like this is a no-brainer. And I can confirm this from multiple sides. I spent 2 hours yesterday with Steve Quirk, who is the chief brokerage officer at Robinhood. Young people, they have 30 million clients. Their typical client is roughly 30 years old. These people are in the accumulation phase of their life. They should be buyers. We have a business at Ritholtz called Good Advice, where we cater to people with account sizes between $250,000 and $1 million. Those people are asking us how they can get more money into their accounts. We're not seeing the panic. We are absolutely seeing inflows and people looking to take advantage of this dislocation. That might not make sense for everyone. And, of course, people that are already in retirement are probably not throwing as much money as they can into more stock exposure. But the demography of this country is important to understand. The most common age to be in America right now, I think, is 30 and 31, meaning we have the most amount of people who are 30 and 31. They don't need to be tactical. They have the next 35 years to work and accumulate assets and make more money. Those people should be buying, and I'm pretty sure they are. I don't think that that cohort of the American investing public is looking at this like, oh, no, the world is coming to an end.
Yeah. Jimmy?
Hey, Josh, it's Jimmy. I got a question. I think this is important. I love what you're saying about the young people. Are they getting the message that you're supposed to go to your best hits, as you just said it? I mean, that is so important. Quality is on, everything's on sale, so why not buy quality? I hope they're not buying, ZTE options. You know what I'm saying. Are you seeing them get the religion of buy quality?
I think one of the most interesting things that I've learned in the last day or so, and people at retail brokerages, not institutions, people at retail brokerages would confirm this. What's interesting is that in bull markets and when the tape is ripping higher, there is a much higher likelihood that retail players are buying individual stocks. When we're in a huge correction or a massive bear market, it's the opposite. They go to ETFs. I don't know why that's the case. I just know that it is. And so, Jimmy, there might be a higher likelihood that somebody looking at the market down 3,000 points in the last 48 hours just says, you know what, I don't know what to do here, but I'm pretty sure the Qs are offering an opportunity, or SPY, or maybe, there's a tech ETF they like. So I think that is a version of going for quality, because you have to assume the largest holdings in those ETFs are the highest quality companies in America.
Josh, thanks. We'll see you next week. Good weekend to you. Appreciate you coming on and telling us that. Courtney Reagan has the headlines for us. Hey, Court.
Hi, Scott. What a day. Well, at the top of the hour, a federal judge is set to hear the case of the man the Trump administration admitted it accidentally sent to a notorious prison in El Salvador. In court filings earlier this week, the White House said Kilmar Abrego Garcia, a protected legal resident who has lived in Maryland since 2011, was sent to El Salvador in March because of, quote, an administrative error. British police charged actor and comedian Russell Brand with rape and multiple counts of assault today. According to a statement, 4 different women have made a number of allegations dating back to a period between 1999 and 2005. Brand has previously denied allegations, saying that all his relationships have been consensual. And Disney paused the making of another live-action princess movie as its Snow White remake flounders at the box office. The studio halted all pre-production work on the remake of 2010's Tangled. This is according to multiple reports. Snow White opened last month to a $43 million box office and then dropped by 66% to just $14 million in its second weekend. Scott, back over to you.
All right, Court, appreciate that. Thank you. Courtney Reagan, much more on the sell-off and the setup next.
For as long as I can remember, I have always considered myself pretty ambitious. I always wanted to be a television journalist. When I started out covering foreign exchange, I actually taught myself how to trade currencies because I wanted to understand what people wanted to know. My grandfather, who was a Holocaust survivor, inspires me every single day. And growing up, he always used to have CNBC on in the background. Every day is fun covering business news. Every day is different. It is never boring.
The climate crisis is a gun to our head, so we better get our act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future, only on CNBC.
Scott Wapner from the NYSE. Closing Bell, CNBC.
All right, we are back. I have another move I want to get to. It's interesting to me, given what you just said to Josh.
Yeah.
You're talking about, I hope they're buying quality. I hope they're buying quality. You've been telling me for weeks that a certain stock is quality, despite all the noise around it. That's United Health, and now I find out you sold it.
Yeah, I thought actually you were going
to square it. I didn't have time to do it then, so
No, I got you. And I thought, let me address this. I'm not talking out of both sides of my mouth when earlier in the show I said this is not a time to sell. This is an offensive move, okay? United Healthcare is up 4% over the last 2 days, while all sorts of quality companies are down 10, 15%. This is a move to free up some cash so I can buy things. I'm going to put that money back to work. I mean, Friday afternoon with a market tape like we've got, it might be this afternoon. I'll be on the show Monday. I'll tell you what it is, but this is a move of offense. Don't mistake it. And sorry, United Healthcare, you did great over the last 2 days. You did exactly what healthcare stocks are supposed to do in a downturn. You held up. I hate to shoot you, but there's just too many other opportunities, and I need the cash.
I love that long-term approach. I think it remains a quality.
Probably a bad choice of words, too.
Yeah.
But
What?
We'll
God darn it.
We'll move.
I apologize. Look, sorry.
We do have breaking news of another company that is looking at these markets and delaying its IPO. Leslie Picker joins us now. Leslie?
Hey, Scott. Yeah, this one, according to the Wall Street Journal, citing sources familiar with the matter, is Chime, another fintech company, reportedly delaying their IPO, at least their public filing, to get that process really starting. These markets clearly kind of the nail in the coffin, whether they're a temporary nail in the coffin for the capital markets or a more permanent one remains to be seen. But we've seen a whole host of companies really kind of pausing their plans to go public. We had Klarna and StubHub, according to people familiar with the matter, that were set to start their roadshows just next week, now have put those plans on hold. Hinge Health is another one that has filed its prospectus prospectus publicly. They had a kind of a longer timeline. They weren't looking to launch their roadshow until later in the month. So those plans are kind of up in the air, remain to be seen just as we watch this market volatility unfold. And talking to sources, the key issue here is that investors are really so distracted by what's going on in their own portfolios. They don't have time in a market like this to take meetings and talk about prospective new issues, new companies tapping the public markets. And so that dynamic is difficult. And then also, just kind of the overall recent IPO market and how things have unfolded there, performance isn't amazing. So it's not one of those things where one could say that the IPO window is dramatically open. But this is important for the revival of the capital markets. It's something I'm sure will be a topic of conversation as banks kick off earnings a week from today. Scott.
All right, Leslie, thank you. That's Leslie Picker on that note, Weiss. I mean, bank stocks have just gotten hammered, and they're getting hammered again today, down 6% and 7% respectively for a lot of the names there.
Yeah, and I think part of that is not just the market, but credit quality. So I would look at some of the, of the stocks that are out there based upon private lending, and also what is typically, higher risk, high yield lending, because you will see, and we've heard them come on the network, a lot of these companies are going to have major liquidity issues, and some may go bankrupt. So it's not a time to be involved in that sector of the market, in my opinion.
So we got the news there, the reaction here. I know you didn't mean it for it to come out that way. Yeah, I just wanted to give you a chance to fix it, just because I didn't want it to hang there.
Thank you.
Like that. We know you. We know certain times things come out of all of our mouths that we're like, I wish I could have that.
And I'm going to be stewing about it all weekend.
You don't have to, because we just took care of it.
Okay.
Leave us, speaking of the weekend, with something to think about for the other side.
Yeah.
How this day might end, what you'd be thinking about in the last couple that we have.
I mean, yeah, I think there's a great give and take between Steve and I, and we've done this for 12 years now, and you're seeing both sides of the coin. So Steve just said something, and I think it was very insightful, about credit quality, and you said something earlier about my talking about jobs reports, which I didn't talk about. So this is where we are. Everything is on the come in terms of the negative news. If the recession hits, if employment falls out of bed, then Citigroup's going to have a really big problem with the credit card receivables that it have. The problem I have with that is it's a hypothetical. It's an if. Right now, we just had a great jobs report. I get it. It's backwards looking, but do bear in mind that this was a period of time where Doge was in full effect, right? We were supposed to be seeing the effects of layoffs at the government now, and weekly jobless claims still hanging in there. I get it, Steve. I can feel you rustling. I get it. Things can change. They may change. Right now, they haven't changed, is my point.
Well, our job is to really look at, as investors, what can happen.
Yeah.
And then to handicap that probability. I put a much higher probability of that occurring. Now, where can I be wrong? I could be wrong. Trump fires Lutnick, uses him as a scapegoat, and retreats from it. He's done that before. He just did it with the deputy head of national security. So anything's on tape. I don't think that will cure this situation.
All right, give me a final trade.
2-year treasuries.
In light of what I just said, J.P. Morgan.
Okay. Again, those stocks have not traded well. Jason Snipe, what's yours?
Amazon, 30% off the 52-week high.
How about you, Bryn?
Restoration Hardware, another name I like in my Vietnam basket.
Well, the CEO, by the way, is going to be on with Jim tonight on Mad Money, so it's a must-see interview, given what the stock has done, the comments that he's already made this week around earnings. I'll see you on the closing bell. The exchanges now.
Thank you very much, Scott. And stocks are selling off sharply for a second straight day as China retaliates with tariffs. It's Friday. We have 2 hours left in the trading week, and welcome to the exchange. I'm Kelly Evans. Here's what's ahead. We're down 1629 on the Dow right now. Job surprise to the upside in March. Let's not forget what happened at 8:30 Eastern, and we'll talk about the impact that it really has. The president taking some credit for that. Also for lower egg prices, for lower energy prices. WTI is down 8% to a 4-year low today. And for lower interest rates, the 10-year yield about 3.9% at last check. Question is, at what cost? The latest round of tariffs leading J.P. Morgan to up their recession odds to 60% from 40%. The economist behind that call joins us live here in a moment. He warns there will be blood. Retail is also still getting hit hard today, but one exception, Nike, Foot Locker on holding. All of these making a U-turn higher this morning. On news, the president is willing to cut Vietnam's tariffs to zero if an agreement can be reached. So you see names with that bigger exposure in the supply chain. In On's case, it's 90% of it, and that's where we are seeing some green and some upside today, although the story keeps changing. Another one we're keeping an eye on. The clock is ticking on TikTok. Don't forget, this is simmering on the back burner. They've got to find a U.S. buyer or face this ban. One of the companies that's made a bid is AppLovin, and the CEO will join us a little bit later this hour. But let's start with the jobs report and everything that's going on with the economy, what the Fed chair just said this morning, and what's it all telling us. Non-farm payrolls rose by 228,000 last month, up from the revised 117,000 in Feb. That was way better than the estimate for 140K. The unemployment rate did rise, 4.2%, highest since November. The jobs numbers aside, one of our next guests is worried that Trump's new set of tariffs pushes the U.S. closer to a recession. As we mentioned, he just raised his odds to 60% from 40. Let's bring in J.P. Morgan chief economist Bruce Kasman. Also here, KPMG chief economist Diane Swank, and our very own Steve Leisman. And what a group to kick things off with this hour. Steve, can you also just quickly bring us up to speed on what the Fed chair in his speech in the 11 o'clock hour said, because that has a lot to do with why stocks are taking another leg down.
Yeah, so the Fed is on pause. I think there's an expectation that as things get worse, the Fed is going to step in. I think that was not what Powell was saying. In fact, you could almost argue the chair was a little hawkish in the following way. He said that it could take several quarters while inflation from tariffs worked their way through. He said that the tariffs were more extreme than he had expected, than the markets expected. He noted that, and so therefore the inflation effect would be stronger. He also said, I'm going to play a soundbite here, Kelly, just for a second, just to show you. I kind of asked him about this at the last press conference, if he would say this, and he wouldn't say it at the press conference. Now he's saying it. We'll play it, and I'll come back and just tell you what I think it means.
Inflation is going to be moving up and growth is going to be slowing, but it isn't really. To me, it's not clear at this time what the appropriate path for monetary policy will be, and we're going to need to wait and see how this plays out before we can start to make those adjustments.
I'm sorry, Kelly. That was not the actual sound that happens on television here that I wanted to play. The phrase he said is, our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. That means they're going to make sure. Go ahead.
Well, no, you say it. I want you to say it, not me.
You got to have the initial round clear. Be sure there's not a second round of inflation before the Fed can respond.
Or I was going to say, and I don't know if I'm putting this quite the right way, if they cut in response, we could potentially get inflation becoming a little bit.
That's another really good way to put it. It also says, if there's a second round, it's our responsibility. And it's our responsibility to make sure there isn't one.
All right, let's bring our experts. Well, you're an expert too, Steve.
Not as much as these two people. Are you kidding me?
Let's bring in Bruce first, who's making all the headlines this week. And Bruce, people will say, well, wait, they know you're not a regular. They know we probably talk to you once a quarter or so. I mean, you are not the first person who's going to come out with some attention-grabbing headline, which is why it grabbed all of our attention. So unpack a little. Your team has done great work this week. We've seen them trying to tally up the estimates of how much tariffs revenue that will raise, how that equals to a tax cut, hike, or so forth on the consumer, and how do you get to a 60% recession call now?
Well, let me say first that I think as we looked at the data this week, both U.S. and globally, we're looking at an expansion that's still standing on solid ground. What we've been watching as we've gone through this year is a tension between a still healthy expansion and a building macroeconomic shock coming from policy. What we got this week was a very big tax increase on U.S. businesses and households. We would scale it in terms of a roughly 20% rise in tariff rates to basically the highest tax increase we've had in the U.S., if it's going to be fully delivered, that we've had since 1968. So there's a big direct shock here that's coming through in terms of higher tariffs. But I think the bigger story here is we're in the midst of a reassessment of business expectations about what this administration is about. The signals that I think are coming through are challenging where we were coming into the year, where people thought that while this administration would move in extreme ways, it still had a commitment to supporting the business sector and the expansion. I think that's being challenged. So the tax increase, if it's being delivered, is going to be magnified by what we think will be a fairly big hit to business sentiment. On top of that, there are disruptive effects, retaliations, which I won't go into, which also comes into our assessment. We put it together. we're worried that over the course of the next 3 to 6 months, this stuff could build to the point that it breaks the expansion.
Steve, I just want to bring you in here to kind of respond or highlight what you think is important about that.
When I read Bruce's assessment, it was the business sentiment thing that stood out to me. And it sort of counts as a shock, in my opinion. And one of the things I think I pointed out several times on this show is the shock is relative to the expectations for President Trump relative to what we're getting now. Some people put it in terms of we thought there was a Trump put. But Bruce is expanding that, if I'm hearing correctly, saying it's not just the tariffs. It's a whole bunch of things. Like, he doesn't seem to be listening. They don't, and across the spectrum, I'm going to put, this is not what Bruce is saying, but that Bessent doesn't seem to be arguing with him. That Kevin Hassett is not doing a job that we all thought maybe Kevin Hassett would do, which is to say, I guess I'll not mince words, say, Mr. President, this is crazy. You can't do this. Right? That's what you would have hoped Kevin might have said to him. Or Bessent. Now, Lutnick, I don't know, because he's seems to be...
But let me rewind for a second.
Go ahead,
this
rewind.
is not going to be a popular take on a day when the Dow is down 1,700
Right.
points. But are they all delivering what the president wishes, which is
Yes,
what voters
absolutely.
wanted him to do?
But the question is, what is the role of a presidential advisor? To do what the president wishes, or to give him the hard, honest truth? And are they giving it to him? And I think I've said this before as well. It seems like there's a difference between the cadre around the president in the first administration and the cadre in the second.
That's intentional, right? The first administration was viewed as kind of having people who knew Washington but stood in the way of the agenda.
There's a line from Airplane that stood out to me, the spoof. I'm not going to say it. Never mind.
What is it? I don't know.
No, I don't. It was Chump don't want no help, Chump don't get no help.
Okay, I don't know the
That was
line.
Florence Henderson talking jive on Airplane.
Let's bring in Diane Swank here. Diane, if you could kind of give us your own assessment of where we're going, the business shock. Again, the jobs report this morning, if it weren't for the tariffs, would have told us this economy actually has more momentum or is creating more jobs than anyone would have anticipated, including the shocks that we had up until Wednesday. So I think that complicates things for the Fed, but I'm curious your take.
Well, we actually now have a recession with stagflation, and that's what the Federal Reserve, a mild recession with stagflation, and this is a high watermark in employment. Now, some of the federal jobs that were furloughed actually didn't get counted as furloughed because the judge had said they had to be reinstated and they're paid retroactively. That's been a slow ramp up to get some of those probationary workers back on the payrolls. But we do know the spillover effects are beginning to come out. We've seen warn notices pick up, and we think there will be some employment losses due to the tariffs as well. And so we're looking at, retaliatory environment, how much retaliation you put in. If you take all of the tariffs at face value, because they layer on top of each other, and many people are not really looking at how these do that, if they were to sustain, they would be the highest since the early 1900s, which is really sort of stunning to think about that. And we agree wholeheartedly with this being a very large tax increase on the U.S. economy. But the spillover into inflation is exactly, we're getting at the same thing that Powell was talking about, is you still get a bump in inflation and you have this slower growth, higher inflation, stagflation scenario, which the markets really have not fully sort of accepted yet because they're looking towards history. While we get weak growth, the Fed cuts. This is not as easy, and as Fed Chairman Powell pointed out today, they're in no hurry and they need more clarity. They need to figure out which is going to be the dominant factor, whether or not they could look through tariffs. You didn't hear him say that today, and I think that's important as well.
Dan, did you hear it as mildly hawkish? When you look at the Fed probabilities, I think we have a chart of that, and I'd love to hear Bruce's take on this. We had gone in with some expectation, actually a 48% probability of the Fed acting in May. That's now down to 30.
Wow.
We had actually, you can't see from this chart, we had a fifth cut on earlier charts. That was up as high as, I think, 60%. That's fallen off. Still, and maybe Diane wants to answer this, is the market too ambitious about planning or predicting Fed rate cuts if Powell is saying inflation over quarters? He used that time period.
Yep. And that's exactly what we're seeing. And basically in our model, once we do the simulations, it's not easy for the Fed to actually begin cutting until the fourth quarter, which is over quarters.
Yeah.
And that is with a recession as well. And I think that's something that the financial markets, the stagflationary scenario, weakening growth, the effects on profit margins, uncertainty wane, all those are important. But it really is hard for the Fed to go ahead and cut as inflation's picking up.
Bruce, can you weigh in and also give us a little bit of your expertise on other foreign banks as well, that they have it easier because they have only a single mandate, most of them. But how do you see the Fed doing this? And what about, say, the ECB and Bank of Canada?
Well, I would agree. I think that Powell was mildly hawkish today, and I think he's making the point that the Fed is not going to move preemptively, that it is going to defend its anchor in terms of its credibility.
Right.
But I would take a little bit of issue with what's been said here. I think the minute the labor market breaks, I don't care how high inflation is, the Fed is easing, and it's easing aggressively because it knows if the economy goes into a recession, that's going to do quite a bit of damage. It's going to bring inflation down with a lag, and it doesn't need to wait to see inflation move lower. So the Fed will be slow in a world in which we don't break. The minute we break, the Fed will be fast.
Yeah, our colleague, Diane, you're shaking your head. Jump in.
No, I mean, if we have a very big break and we have a meltdown, of course the Fed will move quickly. But this is really important because the embers of inflation are still smoldering. We are in a different context than we were, and the Fed has evoked several times the cautionary tale of the 1970s. Now, we don't expect anything like that in terms of a mild bout of stagflation that we're seeing out there, but this is, happening against the backdrop as well of changes in immigration policy, which are already constraining prime age labor force participation. Even though the participation rate picked up in the labor market today, prime age participation has fallen 2 months in a row. It was men falling last month, women falling this month, and part of that is due to shifts in participation by foreign workers.
Bruce, we're at session lows on stocks right now with the Dow down about 1,860 points. I don't want to blame you, but I don't think the idea here of the recession we've outlined without the Fed necessarily helping is doing much to help. So let me just try to add a couple of potential offsets and how does this run through your models? For starters, we see mortgage rates obviously going to fall, whether that's a refi boom, a buying boom, or something more. The behavior of some of the home builders, which are green today, and stocks like that almost feels a little bit like early cycle, and I don't want to go that far, but I just want to throw it out there and ask if that's a countervailing presence. Also, oil prices. This is a big collapse. They're almost below 60 today on WTI. Does that benefit at the pump for consumers offset some of the potential headwinds that you see either?
Well, I think you're raising a really important point here. First of all, we forecast recession. We're not by any means saying that's the only thing that could happen here. I think we have an economy that is still on solid ground. It's getting hit by big shocks. So I think part of the point you're hitting here is really where things are going to matter right now is to what degree does consumer purchasing power get squeezed by higher inflation, and you're right to point out an offset in terms of falling energy prices, and to what degree does a consumer which still has the wherewithal to cushion the blow and has consistently been cushioning the blow of higher inflation and periods of temporary softening in labor demand over the last 10 years, whether it will continue to do so. We're concerned that that's going to be harder to do in a world in which inflation is high, business sentiment is weakening, and the labor market is softening. But it's by no means clear, by any means 100% what's going to happen here. And the points you're raising about some cushions and some offsets here, I think are appropriate to recognize in terms of how we track this.
All right. Go ahead.
I was going to make a very quick point,
put a button in it.
Which is, I think the market is trying to figure out, do they price to Bruce's 60% or do they price to his 40%? And there's also another countervailing force here, which is the more the market goes down, the higher I think there's a probability the president backs off, which could limit to the downside. But I believe, Bruce, if I'm not mistaken, if you have a recession, corporate earnings fall 15 to 20%, and that's not priced in, probably.
Yeah, and I mean, a recession, it would be profits going down 20, 25%, jobs being, basically more than 1 million jobs being lost. That's a recession. I mean, there are other events which could be milder. Recessions are breaks. Mild recessions are only mild in relation to other recessions, and that's why we care about it so much. That's why markets are so sensitive to it. They're breaks. They're nonlinear. They reverberate over time and space, and we should not anticipate what exactly a recession is going to look like once that break takes hold.
All right, Bruce and Diane, really appreciate you joining us today. It means a lot. Bruce Kasman, Diane Swank, Steve, thank you as always, our Steve Leisman. Let's drill down a little on these markets with the Dow almost 1,900 points lower. That's a 4.6%. Now remember, circuit breakers come in at 7%. We're not there yet, even for the NASDAQ and the Russells, which are down about 5%. So they were down a little bit more sharply yesterday than today, but we're kind of splitting hairs. Our next guest is almost in the same camp as JPM, saying the risk of recession is above 50%. And with stock